Hello, this is Joe Pryor, the virtual real estate team in Oklahoma City, and this is my, quarterly crystal ball analysis of interest rates. Now, trying to predict interest rates is sometimes trying to say, what's going to happen at the crap table and trying to predict that in Vegas. It's a very, very difficult thing. Now, since the pandemic hit, it's been a little bit more predictable. Obviously, because the federal government, especially the Federal Reserve, is announcing in advance, far in advance, what their intentions are in terms of the money supply. So what we've seen in terms of helping the economy recover, as I've talked about before, is what's called quantitative easing. This was used back after 2008 in order to get the economy back on track. It was being used again during the pandemic to help people out, to help people pay their rents and have unemployment insurance, among other things. But also the Federal Reserve was buying three things. They were buying treasuries, of course, back. They were buying mortgage-backed securities, and they were even buying some junk bonds to try to keep the stock market stable, to try to keep interest rates low, especially as the government was borrowing more money for stimulus. And so we've seen these incredibly low rates for both owner-occupants and investors, where I can even get an interest rate with a 25% down loan, about 0.75 points on whatever the mortgage amount is, and I can get a fixed rate investor loan at 2.75%, which is nuts. It's absolutely crazy. Now, the one thing that we do know, as I've talked about in previous videos before, is that the market always changes. It goes up, it goes down. Rates go up, they go down. Inflation goes up, it goes down. And the one thing that we have to realize that inflation is on the horizon. Now, how near that inflation is very, very hard to say. But if we're doing more stimulus through the Congress of trillions of dollars, if we're still in a situation where there's $1 trillion or $2 trillion more of quantitative easing going on to keep interest rates low, at some point, the economy recovers and inflation starts to increase, and then the Federal Reserve has got to start selling those treasuries and those bonds and those mortgage-backed securities. And as such, supply and demand, as I always talk about, is something that creates price change. And if prices do change because of inflation, realize that your interest rates are going up. Now, what we believe to be true is that the economy is still not going full blast. It has moderated again. And that is because of problems that we had a resurgence, phase 2, phase 3, whatever you want to call it, of COVID. And as such, there have been problems. And so the Federal Reserve has announced that they are going to continue with the quantitative easing, certainly, I believe, through the end of this year. Now, there has been announcement in the past that they think it's going to take until the end of 2023. I have my doubts about that. Now, I'm not the Federal Reserve. I'm not the chairman of the Federal Reserve, or somebody that CNN is, or MSNBC, or whatever channel, the Fox News, is trying to interview about this. But I do have experience with market cycles in my age and the amount of time I've been in business. And I know that it's going to be going up. And what I'm talking about right now is this is a fantastic year for you to invest in real estate or buy a home, mainly because these rates are going to disappear. I hope they don't come back again. The reason why I hope they don't come back again, it means we've got some serious problems, and I mean big ones. I don't want to see another mortgage crisis. I don't want to see another pandemic. I'm hoping that is things that are behind us. But right now, if you're really into it, this is really the time to take advantage of those rates because they will not last.